Hello, Jim here. It's been a pretty interesting time in the market. It just keeps going higher and higher, and a lot of stocks have gotten really, really pricey. Today, I want to talk about two that I don't think are that pricey. I believe they're at a good value. They also have really good option premium and potentially really good growth long term. I'm going to share with you why I like them, the fundamentals. I'm also going to go into a bit of the technicals and kind of give you an overview of not just why I pick them, but also how I set up a trade with them. So stay tuned. I think you're really going to enjoy what I have for you. Okay, let's jump right in. Now, the first company I want to talk about is Procter Gamble. It's a value company, been around a long time. I've owned them for many, many years and have had really good appreciation. I think my cost basis in my retirement account is like 40 or 50, and I think it's maybe 60 or 70 in my taxable account. So over time, they don't grow a crazy amount, but they still grow, and you get pretty good appreciation, as well as they pay a fairly good dividend rate. It's about 2.35% yield, which over time has worked out pretty well. They have really good profitability, nearly 30% for return on equity. Return on assets is really good. Their cash from operations, nearly $20 billion. So just a well-run company. They've had good management, and they're well-run. Trying to think of other things. Growth, they don't grow significantly. They're like a Coca-Cola or any other value company. It's more slow growth, but they're run so well that potentially, even with small growth, you still see some pretty good appreciation over the years. Dividends, their payout ratio is 58%, which is good for such a big company. Their annual payout is $4.03. This is a 2.35% dividend yield. And I've been able to more than double the dividend. I'd say I've been probably able to triple it selling covered calls. And they've been increasing dividend for 68 years, a lot like Coca-Cola. I think Coca-Cola is probably around the same number of years. So overall, fundamentally, good company. They look really good. You also, if you look at them, let's look at the interactive chart. This is Barchart. What I was just in was Seeking Alpha. I like to use both. I'm an affiliate of both. You can check in the description if you want to take a look at, potentially getting either one of these tools. So their upper and lower bands are right around 177 and around 166. So 165. You're outside their lower band. If you can get 160, you're significantly outside of their band, their lower band, that is. And then if we come down and we look at option prices, and I do like how Barchart has the delta. I would probably look at 1220 at this time. It's 60 days out. I typically like to go about 60 days out. So this is calls. Let's jump down to puts. I'm looking for around a 15 delta. So in between these two, and voila, what is it? 165 and 160. So with 160, it's a lot less. You're bringing in between 76 and 85, or with a mid around 80. So not bad. If you're doing a cash secured put for $80, that may not be too bad. You take a little bit more risk, and you can bring in around 150, 160. And then if you do a 165, 155, you're almost going to make about $100 here. Now, I believe they were up Friday, so if we do get a downward market, maybe the market's red on Monday or Tuesday, you could potentially do it even a little bit better. You might be able to pick up a bit more. As you can see here, it was down nearly 37 cents because the market was up, or the stock was up on Friday. So maybe 160 might look better. Even though I'm looking at these numbers, it's over the weekend, and the market can radically change. I used to provide specific picks related to strikes, and then I found that it radically changed between the weekend and Monday. So it wasn't worth it. So now what does this look like when you're putting together a trade? So this is what's called a vertical put credit spread. And it's only because you're using the same expiration, which is 12/20, and then I'm selling a 165 put and I'm buying a 155. So this is the spread. It's a $10 spread. Both of these are puts. So I'm selling to open one contract and then I'm buying the 155. So I'm protected. Anything below 155, I do not really need to worry about. Actually, I got these backwards. So this should be buy to open, and okay, that's more like it. So I'm buying the 155 and I'm selling the 165. So sell to open one PG, one contract of Procter Gamble at 165 would bring in around 142, and I would pay 52. So you're talking between, on the mid would be 103. What I typically do is I like to get pretty close to the ask. So I would come over here and I would probably look at 114, and this would be a limit order. So I'd be saying, open a position where I'm buying the 155, I'm selling the 165, I'm making pretty close to $114. Then I would click review the order, and then I would check everything again, make sure everything looks good. If I get confused and I want to be sure I'm not taking too much risk, I can come over here too. I can also look at Delta here, and this is Schwab if you're not sure where I'm actually, where this trading page is. This is actually on the old portal for Schwab, which I still use primarily. I'm probably going to do more with Thinkorswim, but I still end up going back to this because I've been using it for so many years. So I can see here it's a delta of 23, and again, being it's Procter & Gamble, I'm willing to take a little bit more risk. Now, what I typically do is, and if I want to close this, I just click that again. I usually will do two trades. So I'd bring in $228. What would happen is once I click review order and then I click place order, if it's not filled right away, it'll give me the opportunity to then replace the trade. I can then kind of work my way down towards this 103. So I might first do 114, then I might try 112. A lot of times, the second or third time that I'm doing a limit order, it'll take it. So maybe it doesn't take it at 114 or 112, but at 110, a lot of times my trades end up going through. So this is what it would look like, a trade setup for Procter & Gamble. And again, like I said, it's a really good company. I've owned them for many years, and I would not mind owning more. So I probably will make a trade on them coming up in the coming weeks, especially if we get a correction. So, well, that being said, let's jump into the next stock, which is radically different than Procter & Gamble, but also a giant company that I think might even have more potential than Procter & Gamble. Okay, now my second stock is Micron Technologies. Now I currently own 200 shares. I believe I've owned them since 22, and my cost basis is around 60. So I've done quite well with them too. Now, are they overpriced? I don't think so. They have a huge growth spurt coming up. Probably it started this quarter and will go to next quarter and well into next year. But overall, their earnings per share is $8.91. Their PE is relatively low at 12.47. Now, if you looked at NVIDIA, I think NVIDIA is pretty close to 50. If you looked at Palantir is probably 130, 140 PE. So definitely not overpriced. If we look at profitability, their profitability is really good. It's also an A+. Their return on assets is low, so is their return on common equity. And I believe it's because they've done a lot with retained earnings. I believe they've spent some money buying some other companies and doing some foundry type updates. They're a chip maker, but they're not priced really high, which I really like. I mean, the fact that they're right around 111, they were in the 80s and 90s for the longest time. And I believe that's when I did my first trade. They might have been in the 70s or 80s, something along those lines. They also produce a lot of cash per share, and then also a lot of cash from operations, which is really good. They do pay a really small dividend, not much. Its payout ratio is relatively small, 36%. Their growth is substantial. They're growing pretty significantly, which is good. You don't see companies their size growing the way they are. Now, if you look at earnings, this is where it gets a little bit crazy. Now, their next earnings date isn't until 12/20. They just, back in September 25th, they beat earnings. They beat both regular normalized earnings and GAAP earnings. And this may not look impressive until you realize, well, look, this is 100%, 200%, 300%. They're potentially growing their earnings by huge amounts, 371%, 277%, 139%. And this is year over year, of course, compared to the previous year. So their fundamentals are really pretty amazing. Their financials are fine. They don't have a whole lot of debt. If we come over to their balance sheet and we come down to their debt. So here's long-term debt. It's been over 11 for several years, 23 and 24. But if you look at their common equity, it's over 45,000. So, 11 divided by 45,000, it's like a 20% debt to equity. So fine, it's not overly concerning. So they also have really good management. Management's been in place a long time. So they fundamentally look good. So next, let's jump into the Bollinger Band. Let's see what it looks like. And the different bands, the middle of the band, which is the average, rolling average is, I think it's the 20-day rolling average, is 104. The low is 93. The high is around 113. So if you could pick them up below 90, which would be right about here, or like around maybe even 85 or something along those lines. But again, since they're not overpriced, you could take a little bit more risk and try to pick them up around 90. So that's probably what I would look at for doing a new trade. I currently have a trade on them, and I believe it's right around that same value. Let's come down and let's actually look at the option prices. Let's again go out to December 20th. So right here, I believe over here their earnings. Let's make sure that it's right on 12/20. So might want to look, instead of 12/20, let's look at 11/29 and see what that looks like. Let's come down to puts. I don't really want it to be expiring on the same day as earnings, but let's compare. We'll compare these to what it looks like. So if we come to a 24 delta, it looks like it would be below 102. Can we do the number? I believe we can. Trying to see, can I stretch out the strikes, expiration value graph stacked? Oh, here we go. Instead of near the money, let's do 50 strikes. And we're going to 11/29. So let's look for more like a 15 delta. So here we have delta, this column over here. And it looks like a 15 delta is right around 97. And it's around 144 or 148, which isn't bad. And if we bought an 85 or an 80, looks like it would be 89 or 90. So that it's a little bit interesting. 67, 148. So we're talking pretty close to 100 per contract. Let's actually look at what December 20th looks like. Let's come down again to puts. Let's look for the 20 or the 15 delta. Oh, this is calls. So let's come down here. 15 delta would be right at 92.50, and you're bringing in pretty close to $200. And then if I did the 82.50, 78, so that's probably what, 130, 140 per contract? Right in that range I like. Now the risk would, again, being December 20th is the fact that expiration is the day of earnings. So what would you have to do? You'd have to be sure to get out of this position or roll it before December 20th. But let's see what a trade would look like for them. So here I've actually opened it. I've gone out to December 20th. I've opened a new vertical put credit spread. Again, the spread is $10. That's what I like. Some people will do a $5 spread. Some people will do a $10 spread. And I'm buying to open in 85. So I'm protected below 85 for Micron. If Micron goes below 85, I'm protected to that point. And this would become worth more and more. This put that I would purchase at 85 would become worth more and more. So if I decided, well, I still want to own them, this 85 put would become, I could end up selling it and put that money towards the purchase at 95. So the cost basis at 95 would come down. So I'm buying to open one contract in Micron at 85. This is what the bid and ask and mid looks like. And then I'm selling to open one contract, Micron, at 95. And you can see 235 to 252. Let's just verify. Yeah, so an 18 delta. So I would be bringing in, the mid is 147. So, and again, I would try to get it pretty close to this 157. So I would probably come up and do 155. And then I like to go to two contracts. At some point, I do look at doing three. So if I think this is an excellent trade and I really want to own them, then I may do three contracts. I would look at how profitable this trade is. What's the chances? I'd probably come back over to the charting that we were looking at a minute ago. I'd look at the interactive chart again. And I might even go a little farther out just to see what it would look like. So I could go to 3 years. And if I picked it up around 90, it's still a pretty, because if it's 95 and then I'm picking up $1.50, really my cost basis is here. If it dives, I could probably pick it up around 90. So I am taking a bit of risk, but it might be well worth it, especially when you go back to these fundamentals and you see the major increase in earnings that they're going to have. And then you also look at the growth and how much growth they're going to have. It may very well be worth it, especially 61% growth for such a big company is pretty substantial. So I might actually do three contracts and take a little bit more risk and pick up $465 instead of going with two. Now, if you're a new trader and you're just learning how to do this and you haven't been trading for a while, then I would suggest only one trade, and you might want to do a little bit less risk. Well, you can make it less risky by doing a smaller spread. So a 95.90, you're taking less risk. You're per contract, that's $500, but you're picking up between 67 and 83. So that's one way to do it. You could also, you might decide, well, let's see if I can do 11.15, and let's look at what this is. So if we look at the quote for this, you're talking a delta of really, really low. So here I'd have to take, in my mind, a little bit more risk on 190, and maybe you only want to do a $5 spread. So yeah, $74, not bad. And that's a 1780 delta. So for one contract, you're bringing in, hopefully you're getting closer to this 83, but you're bringing in maybe between $74 and $80 per contract and putting at risk about $500 minus whatever premium you bring in. So say you do bring in the 74, you would be bringing, your risk would be $500 minus the 74. And this is where I say, well, start with one contract. As you get more experience, then you can go to 2 contracts or 3. And then you might also decide, well, I want to take a little more risk and maybe even widen the spread more and more. So that's how I approach a lot of these trades. I try to keep them as simple as possible. Once I'm happy with what I'm seeing, then I review the order, and I always try to make sure that everything looks correct when I do review it, and then I place the order. So I keep it fairly simple, and pretty much any broker, it looks similar to this. You work with it in a similar fashion. So that's what I wanted to share with you guys. I really like both these companies, and I'll probably make trades in both of them in the coming weeks. So let me know what you think. Do you have a couple of other stocks or companies you think would also be, a good opportunity at this time who are not overpriced? Again, so many companies now, because of this market run up, in my mind, are very, very pricey and very risky in my mind, because they could drop significantly. I'm not saying that Micron won't drop or Procter Gamble, but both these companies, compared to some of the others, are not way overvalued. So let me know what you think. Please leave a comment. I typically respond to them pretty quickly. And as always, if you want to learn about my memberships, they're growing. I have more and more people sharing their trades in the Discord and lots of lively discussions. We have a meeting tonight, the trading club membership. We have the meeting tonight at 8 p.m. where we're going to talk about a lot of similar stuff as this. And I end up having quite a few people show up at those meetings. And it becomes pretty nice interaction, a lot of pretty interesting discussions. So as always, thanks for taking the time to watch the video, and look forward to seeing you next time.